Well, good afternoon. And to any early risers joining us from Europe today, good morning. Wherever you're joining us from, a very warm welcome to you all. My name is Caroline. I'm Marketing Director at the Fry Group, and I'll be your host for today's webinar on the topic of returning to the UK. Now, a few housekeeping notes before we get started. We've switched off your cameras and your microphones to help minimize any interruptions or disruption. We expect the webinar to last for around 1 hour. And during this time, there will be some time allowed to answer your questions. So please do type your questions into the Q&A box, which you'll see at the top or the bottom of your screen as we go along. And we'll try our very best to answer as many of those questions as we can towards the end of the session. If you miss any part of today's webinar, or you want to go back over any of the points, please don't worry, there will be a recording available on our website in the next few days. And if you'd like us to send you a link to that recording, please do reach out to a member of the team after the session and we'll be very happy to send that to you. Now, the last few years, they've been nothing short of eventful. And for expats living overseas, COVID-related restrictions and border controls have caused many of us to reevaluate whether to continue living overseas or to head home perhaps a little earlier than originally planned. So for those contemplating a return to the UK, as well as the very many practicalities involved with an international move, there are some very important tax and financial planning considerations for you to be aware of, ideally long before that move becomes a reality. And so today, Peter Webb, our Head of Tax Advisory at the Fry Group, is going to help us better understand the complex UK tax system. He's going to share some tips on how you can limit your exposure to UK tax on return. And he's going to share some of the common mistakes to avoid when you're actually planning your move back. So with that, I'm going to hand you straight over to Peter. Peter, it's over to you.
Thank you, Caroline. So let's get started. Now, please bear in mind that you shouldn't take any action on the basis of my presentation today without seeking specific tax advice for your own circumstances. I would also mention I'm only talking about UK tax. Please do have regard to tax implications and tax reporting requirements that may arise in any other relevant jurisdiction for you. As Caroline mentioned, at the moment, I'm speaking to a large number of expats who are moving back to the UK. So we talk to them, we help them avoid making mistakes on the UK tax front when they do actually make that move. So you'll see on the slide that that's our agenda for today. That's what we're going to try and talk you through. And you have the opportunity to ask me some questions at the end. But I've got a couple of questions for you as well, and we're going to start with the first of those. So the first question I have for you is, when are you planning your return to the UK? So you should see some choices popping up on your screen now. So I just give you a couple of minutes or just a little moment to pop your answer in. Okay, lots and lots of you voting on that one. Just give you a few more moments. Okay, I think that's settled down. So I think we'll close the polling there and then we'll share the results. So goodness me, we're actually looking at a quarter of you looking to return to the UK within the next 12 months. And another quarter is going to be within the next 2 years. So that's half of you expect to be back in the UK within the next 2 years. That really is quite extraordinary. We do this question quite often, and I think that's the most interesting result I've seen on that one. Okay, let's move on. So, okay, so what do you need to consider when you plan that move back to the UK? So I've just put some ideas here, the kinds of things you need to be thinking about. When you actually come back to the UK, there are an awful lot of ducks that you need to get into a very neat row to make this work efficiently for you. Considerations, well, what's the timing? When are you going to come back? Will your family be returning to the UK ahead of me? So that's really important, and we'll talk through one or two scenarios where that's gone a little bit awry on the UK tax front. The timing of when accommodation becomes available to you, either in the UK or perhaps when you give up accommodation overseas. Again, that's really important on the UK tax front. And again, that's where we can see some mistakes and missteps actually made. You need to consider the cost of living. You might be in quite a benign tax regime at the moment, and the UK is very far from a benign tax regime. It's very confiscatory. So have you considered how much tax you'll actually pay on your income when you are in the UK? Finally, bearing all of the above in mind, what we want to focus on, are there actions that you can take while you remain non-UK tax resident that are going to reduce the amount of tax you pay after you return or move to the UK? So why do you care about becoming UK tax resident? Why is this an issue? So your UK tax resident status determines how much tax you actually pay in the UK. So if you're not UK tax resident and you've been non-UK tax resident for more than 5 years, generally you're only going to be charged to UK tax on UK sources of income. Overseas sources of income are not charged to UK tax. And when we think about UK capital gains tax, the exposure would lie with the disposal of UK land and property only. Any other capital gains that you make on disposing of anything else is not within the charge to UK capital gains tax. But after you become UK tax resident, and if you're UK domiciled as well, domicile is a different concept that we're going to explore a little bit. So you're UK resident, you're UK domiciled. As soon as that happens, from that day going forward, you're fully liable to UK tax on your worldwide income and worldwide capital gains as they arise. So your UK tax resident status is incredibly important. And your really precious non-UK tax resident status, which really reduces your exposure to UK tax, should be preserved for as long as you can possibly do that. Now, I mentioned being non-UK tax resident for more than 5 years. If you're non-UK tax resident for less than 5 years, and then you return to the UK, there are some really, really tricky rules that you need to be aware of, and we'll explore those in a little minute. Okay, so I mentioned domicile. So you have that really important UK tax resident status. Now, as well as a tax resident status, you have a tax domicile status. Now, your resident status is assessed each year under the complicated statutory residence test. But your domicile status is assessed perhaps over your lifetime. Everybody has a domicile status at every point in their lives. Now, generally, under the UK rules, you acquire a domicile status from your father when you're born. We call this a domicile of origin, and it's a very hard domicile to shake off. Now, I've said that very generally, matters can be far more complicated than that. Now, why this matters? If you're UK domiciled, your worldwide estate, all of your assets everywhere are within the charge to UK inheritance tax. That could be 40% on everything above £325,000. It's a huge liability. But if you're not UK domiciled, then your exposure to UK inheritance tax is limited to UK assets only. Your overseas assets as a non-UK domicile are not within that 40% UK inheritance tax charge. You can see that that's hugely advantageous. Now, in addition, a non-UK domicile who is UK tax resident is taxed on their UK income and gains. But unlike a UK domicile, they have the ability to exclude what we call unremitted overseas income and gains from UK tax. So we're going to touch on this again in a little bit more detail. But I think it's worth reiterating that that non-UK domicile status has a huge advantage, but it has a limited shelf life after you move to the UK. And again, we'll touch on this in a little while. I think one of the biggest mistakes that I see is an assumption that living outside of the UK for, say, 20, 30, 40 years is enough to shake off a UK domicile status. In and of itself, just spending many years overseas is simply not enough to use your UK domicile status. Okay. So we've been exploring the differences between being non-UK tax resident, where your exposure to UK tax is really limited, to when you are UK tax resident, and then that exposure to UK tax could be on your worldwide income and gains. So now we're going to focus on that tricky transition between being non-UK tax resident and becoming UK tax resident. So I think the first question to ask is, how do you know if you're a UK tax resident? So since 2013, we've actually had a statutory residence test. It's now enshrined in legislation, and the test is used to determine your UK tax resident status. The statutory residence test, the SRT, is a three-part test, and you determine your UK tax resident status each year using this three-part test. First part of the test is, can you meet the conditions to be automatically non-resident for the whole year? But if you can't do that, then you have to ask the question, well, if you're not automatically non-resident for the year, are you actually UK resident for the year? So that's the first two parts, automatic non-residence or automatic UK residence. Now, if your UK resident status is not determined by either of those tests, then you fall into the third part of the statutory residence test, which is what we call the sufficient ties test. And that looks at how many ties you have with the UK. The more ties you have, the less time you can spend in the UK. The fewer ties you have, the more time that you can spend in the UK. Why we like the statutory residence test is that it gives certainty. It sets out really clearly what the rules are. What we don't like about it is the rules are very complex, and there are many of them, and there are big traps in there for the unwary and ill-advised. And it's that complexity with those rules that leads to mistakes being made. So we're talking about that transition between being non-UK tax resident to becoming UK tax resident. And under the statutory residence test, you're either UK tax resident for the year or you're non-UK tax resident for the year. So when you think about that UK tax year, it runs from the 6th of April to the following 5th of April. We're in the tax year that started on 6th of April 21 and ends on 5th of April 2022. So under the statutory residence test, if you actually become UK tax resident, perhaps under those automatic UK residence tests, what's to stop you being UK tax resident for the whole of the year? So take a scenario, you come back to the UK in Christmas 2021. What's to stop you being UK tax resident all the way from 6th of April 21? There's this thing called split year treatment. And what split year treatment prevents you from becoming is UK tax resident for the whole of the year. And what it allows you to do is to preserve your really helpful non-UK tax resident status until a date later in the tax year. So there's a lot of complexity there. The takeaway from this slide is split year treatment is your friend, and it helps you to remain outside of the scope of UK tax on your worldwide income and gains for a little bit longer in the tax year. Okay, so we're talking about split year treatment. And I think this is the one area where I see the most mistakes being made. So when you return to the UK from overseas, so you've been living overseas for some years, you return to the UK, you want to try and benefit from split year treatment because that helps you to stay non-resident for a bit longer. So how could this go wrong? So there are 5 different ways, there are 5 different cases of split year treatment that could apply to you. And that's really complex. And you're going to be in a position where perhaps 3, 2, 4 of those split year treatment provisions could apply. And if you've got more than one case of split year treatment that applies, there's an order of priority in which they apply to you. Now, that's all sounding very complicated. So I think the easiest way to illustrate how this can go wrong, how you can make a mistake with this, is to talk through a couple of real life scenarios. Now, what I've done is to change the names to protect the innocent on these, but these are real life scenarios that we've seen over the last few years. So we have a guy called Duncan, and he was living and working in Singapore for many, many years. Now, he returned to the UK in 2018. It was November 2018. So that's in the 18-19 tax year. He hadn't visited the UK at all between 6th of April 2018, the beginning of the tax year, until he returned in November 2018. But his wife and children actually travelled back to the UK ahead of him. And they arrived in Bristol in June 2018 to make sure that the children were ready for the school term in September 2018. So family arrives in Bristol and they start renting a property in Bristol to have some accommodation. Now, what happened with this for Duncan, where this went wrong, is that he became UK tax resident when he started to have a home in the UK. So that was June 2018, which was many months before returning to the UK in November. And the outcome of this was that he had to pay UK income tax rates on his Singapore salary for June through to November. And that's, of course, a far higher rate of tax. It was an unexpected consequence of the split year treatment rules that meant he became UK tax resident way before he physically arrived in the UK. So another example, Giles, not his real name, but a real situation. Giles returned to the UK in December 2017. After many years, he was actually working in the UAE. Now, his wife and children had continued to live in the UK throughout his time overseas. They'd been UK tax resident, he hadn't been UK tax resident. His rental agreement on his apartment in Dubai actually ran out in August 2017. Now, he knew he was going to be contracted through to December 2017, but he didn't want to enter into a new rental agreement. So he actually moved into the Fairmont on Sheikh Zayed Road and took a serviced apartment there. For those of you who know Dubai, you'll know that hotel. So what happened with Giles is that he gave up his home overseas and moved into temporary accommodation in Dubai in August 2017. Now, he actually became resident in the UK in August 2017 because one of the split year treatment rules for him was that there was a date in the year when he started to have his only home in the UK. So the takeaway from this slide is that split year treatment is your friend, but it's complicated, and it's entirely possible to become UK tax resident and fully exposed to UK tax on your worldwide income and gains many months before your physical return to the UK. There are some really special and quirky rules if you've been outside of the UK for less than 5 years, and we'll just run through a few bits and pieces on this here. So we call this temporary non-resident. What happens to a temporary non-resident is that you can be charged to UK tax on certain income and gains you've received or have brought into the UK in a period of temporary non-residence. So a period of temporary non-residence is a period of less than 5 years, or 5 years and less, of being non-UK tax resident. And before you became non-UK tax resident, you were resident in the UK for 4 out of 7 years before leaving the UK. These rules actually catch various bits and pieces. The one that we see most commonly is capital gains. So you make a capital gain in a period of non-UK tax residence, it's caught for the temporary non-residence rules. Other things that are caught for this, pension payments, some pension payments are caught, some quirky things under the disguised remuneration rules that are caught. If you're non-UK domicile and you're using a special remittance basis of taxation, which we'll go into in a little bit, the remitted foreign income can be caught too. Distributions from closely controlled companies, chargeable event gains. So I think the takeaway here is that there's a lot of complexity if you're non-UK tax resident for 5 years or less than 5 years. So you need to put it around another way. To avoid the temporary non-residence rules, you need to be continuously non-resident for more than 5 years. That's a better way to say that. Now, what happens if you're caught for these rules is that if you make a capital gain, say when you're overseas, you're not charged to UK tax at the point where you make the gain. But if you, in the year that you return to the UK, you are then charged to UK tax on that capital gain if you're actually caught for these rules. So I've mentioned non-UK domicile a couple of times. So it could be the case that you've become UK tax resident, but actually you're not UK domiciled. Now, that non-UK domicile status, as we've briefly mentioned, has a very big advantage for inheritance tax, but it also has an advantage for income tax and capital gains tax as well, because a non-UK domicile has the opportunity to exclude what we call unremitted overseas income and gains from UK tax while they're actually resident in the UK. It's a big advantage, but there are various conditions that need to be met, and there are some cons to this. So the overseas income and gains that you're excluding from UK tax on the basis of your non-UK domicile status, they actually need to arise outside of the UK, and they need to stay outside of the UK. You can't enjoy them in the UK. In addition, you lose your entitlement to an income tax allowance and a capital gains tax exemption. I'll set those out for you on another slide. Once you've been UK tax resident for 7 out of 9 years, and you want to continue to use this remittance basis of taxation, you actually have to pay an annual, a yearly remittance basis charge. And that's an eye-watering £30,000 a year, which then goes up to £60,000 a year after a few years. You don't have to do that. As a non-UK domicile, you always have the choice to be taxed on your worldwide income and gains instead, which means you keep your allowances and you don't have to pay that annual charge after 7 out of 9 years. So it's a choice that a non-UK domicile has when they become UK tax resident. And one of the things you do before you become UK tax resident is make a decision as to whether or not this is going to work for you, because there is some structuring to do with your overseas sources of income and gains to make sure that this is going to work well. Okay. So we're going to move on and think about, well, what are some of those things that you can do before you become UK tax resident that are going to save you some tax as a UK tax resident? But before we go any further, we're thinking about UK tax. So another question for you. So as a UK tax resident, what is the highest rate of income tax that currently applies in the UK? So that question is going to pop up on your screens now. And we've got 3 different rates that we can think about. We've got a 40% rate, a 45% rate, and a 46% rate. So I'm just going to give you a second to make your choices and see how we do with this one. I think that's, oh no, people are still voting. This is really interesting, actually. I think that's kind of settled down. All right, then. So what did we go for on this? So we had 26% of you thought it was 40%. I'm sorry, but I think that is a bit of wishful thinking. It is a little bit higher than that. Half of you went for 45%. I think that's a little bit nearer, but half of you are actually wrong, because the highest rate of income tax that applies in the UK at the moment is 46%. So England, Wales, Northern Ireland, we're looking at 45%. But in Scotland, actually, the highest rate of income tax is currently 46%. Okay, so there we are. So the first thing I'm going to think about, what are some of the things you need to consider to make sure that you've positioned yourself well as a life for life as a UK tax resident? So a good starting point is to consider employment income. And I'm just going to pick up on a couple of different things that you need to consider. Termination payments. These are horrendously complicated for UK tax. If you're UK tax resident at any point in a tax year, when you receive a termination payment that has perhaps been earned while you've been fully non-UK tax resident, that termination payment could be charged to UK tax in full, even though it's got nothing to do with the UK. A couple of choices with that: either in the year that you receive a termination redundancy payment from overseas, you remain non-UK tax resident throughout that tax year. That's the safe option, that's what you do. But sometimes you don't have a choice about when you come back to the UK. So if you are going to receive a termination payment, you're going to be UK tax resident in that year. You need to look very, very carefully at the double taxation treaty between the UK and the relevant country, because there may be some help there. Share schemes are pretty tricky as well. So what usually happens is you're granted some shares, and then maybe 3 years later, those shares will vest. Well, if you've become UK tax resident in that period from grant to vest, there is going to be some income tax and national insurance contributions to pay on that share scheme. So just think about that. Maybe your company can actually help you with that, maybe accelerate some vestings, or at least you can be forewarned and know that that's going to happen and make provision for that. Probably the easiest thing on this slide to mention is that bonus payment, where you have a really simple cash bonus, and it relates to a time when you were fully non-UK tax resident, no UK work days, so perhaps it's a calendar year when you're fully outside of the UK. That simple cash bonus will not be subject to UK tax, even if it's paid to you after you've become UK tax resident again. So moving on from employment income, your investments. So you need to think about your investments. So if you're not caught by the temporary non-residence rules, that there are many things that you can do. I'm just going to summarize a few points here. So very general principle: if you have assets standing at a gain, then dispose of those before you become UK tax resident, and that avoids a future charge to UK capital gains tax. Just bear in mind there might be some tax consequences somewhere else for you doing that, but from a UK point of view, that's a sensible thing to do. Now, I think where I do see mistakes being made is that many people will actually sell out of everything before they become UK tax resident, in the belief that that's going to make them as tax efficient for life in the UK as possible. But actually, if you've got investments which are standing at a loss, you want to keep those until you become UK tax resident. If you realise the loss now, that loss is not available to offset against any taxes in the UK. If you realise the losses are non-resident. But if you keep the asset standing at a loss until after you become UK tax resident, you realise the loss then, and that loss is then usually available to offset against future capital gains. Quick summary: standing at a gain, dispose of it before you become UK tax resident. Standing at a loss, keep it and take the loss after you've become UK tax resident. Final point on this slide is around pension schemes. So Singapore CPF scheme, Hong Kong Mandatory Provident Fund, you may have other overseas pension schemes as well. It may be the case that while you remain non-UK tax resident, you might be able to access those funds with little or no UK tax to pay. That may not be the case after you've become UK tax resident. You do need to speak to specialists about this to understand if that's the best thing to do to access your overseas pension scheme before you become UK tax resident. I think perhaps the one thing to say about overseas pension schemes is that the one thing not to do is nothing. Do take some advice just to see if there is going to be an advantage for you taking some action with your overseas pension scheme. So you want to think about how you're going to be tax efficient with your investments after you've become UK tax resident. And that's going to be a very, very individual and personal plan based on your circumstances, your income needs, your domicile status, your retirement objectives. I think the one thing that you would focus on this slide, I've actually listed the tax allowances that are available to you each year on a use it or lose it basis. The UK is a very confiscatory tax regime, but there are tax efficiencies to be had. So use your personal allowances between all of you each year. And just to pick up on one of these, when you're UK tax resident, you can invest in ISAs each year. So you can have shares, securities, unit trusts, cash, maybe in an ISA. So perhaps a couple can invest £40,000 in ISAs each year as UK tax residents. And over a few years, that's going to be quite a tidy sum in terms of investments that you can hold in ISAs, individual savings accounts. And the advantage is once they're in the ISA, they then are free of income tax and free of capital gains tax. Other things to consider are around residential property, particularly in the UK. Now, when you dispose of UK property as a non-UK tax resident, and you've been non-UK tax resident for more than 5 years, so you're not a temporary non-resident. So if that's you and you've got UK residential property and you sell it as a non-resident, it's only the gain arising after 5th of April 2015 that is actually charged to UK capital gains tax. Compare that with being a UK tax resident, you sell UK residential property and the gain arising over the life of your ownership of the property will be charged to UK capital gains tax. So if you've owned a UK property for many, many years, there could well be a big advantage to selling that UK property before you become UK tax resident, when it's only the gain arising after 5th of April 15 that is actually charged to tax. A couple of more points on this are that if you do sell UK land and property now, you have 60 days to report that sale to HM Revenue and Customs, and within that same 60-day window, you have to pay any capital gains tax due as well. So it's quite a tight reporting and payment deadline. Final point here, have you ever lived in that property as your main or only residence? Has it been your family home at some point? If that's the case, then the decision to sell as a non-UK tax resident is not automatic. It might be the case that if you go back and live in that home once again, genuinely as a home, you might be able to maximise what we call main residence reliefs that reduce the capital gains tax payable. The takeaway on that is if you've lived in the property as your home, you're not UK tax resident, and you're thinking about selling, speak to somebody who knows about these things, because there could be an advantage to go back and live in it as a home once more. Okay, time to consider inheritance tax. So inheritance tax is the most punitive weapon in HM Revenue's arsenal. I think a 40% charge on everything you leave to your intended beneficiaries above £325,000. It is the nightmare scenario that you're looking at. Your liability to inheritance tax, as we've mentioned previously, is determined by what we call your domicile status. And if you're UK domiciled, your worldwide assets are within that charge to UK inheritance tax. However, if you're not UK domiciled, only UK assets are caught for inheritance tax. Overseas assets are outside of the scope of that 40% UK inheritance tax charge. But something to consider about becoming UK tax resident is becoming UK tax residents then triggers an expiry date on that really helpful non-UK domicile status. I think the longest you could remain non-UK domicile is 15 out of 20 years of UK resident. And at that point, if you've not been seen to become UK domiciled before then, and you've gone to the outer limit on this, at that point, when you become UK domiciled, your worldwide estate is brought within that UK inheritance tax net, and you need to make a plan for that. And the reason for mentioning this in a return to the UK presentation is that there could be actions a non-UK domicile can take to permanently exclude wealth from UK inheritance tax, even past the point where they are seen to have acquired a domicile of choice in the UK and a UK domicile that way, or they've gone to the outer limit and have triggered UK domicile status by being resident for 15 out of 20 years. But if you're thinking about actions to protect wealth from UK inheritance tax for a non-UK domicile, the best outcome is to think about that before you become UK tax resident. Even if you're UK domiciled, there is an effective plan for inheritance tax. And what I would say, just very briefly on that, bottom point on this slide, is that one of the simplest ways to reduce your exposure to that 40% inheritance tax charge is to make outright gifts during intended beneficiaries during your lifetime, with some conditions to be met for that. The reason you would think about that while you're non-UK tax resident is that gift is unlikely to be within the charge to UK capital gains tax. But that kind of gift you make as a UK tax resident is very likely to be charged to UK capital gains tax. So something to think about before you become UK tax resident. Do you have the opportunity to restructure your assets for inheritance tax efficiency without having that UK tax charge for perhaps gifting assets away? Okay, you need to tell HM Revenue you've returned, but maybe not straight away. So there's no separate form to complete to tell HM Revenue you've turned up in the UK. I think the really important thing is to make sure that you've actually told HM Revenue if your address has changed, because you don't want to miss any important communication from them. When you actually tell HM Revenue of your UK resident status, well, you do that on your tax return. And if you want to claim split year treatment, that's on your tax return as well. We're in the 21-22 UK tax year at the moment, and the filing deadline for that tax return is actually 31st of January 2023. So you're not actually telling HM Revenue that you've returned to the UK, perhaps until well after the date that you turned up. Okay, well done for bearing with me this far. If you're struggling, we're almost there. So we're going to move on to my key takeaways for today. So just to summarize a few really important points. You need to make sure you know the date that you're going to become UK tax resident, because that then gives you a clear trigger for the actions you need to take before that date. I think the other thing I would say in this is now is the time to think about reducing your exposure to UK inheritance tax, because while you're non-UK tax resident, there may be some bits and pieces that you can do free of UK tax that are going to be charged to UK tax after your return to the UK. And finally, don't forget your reporting obligations and tax liabilities in the country you're leaving as well. Okay, so I'm sure you've all been asking some really interesting questions. So I'm going to hand over to Caroline, who's going to host our question and answer session.
Great, thank you very much, Peter. Peter, I've heard you speak on this topic. I can't even begin to count how many times over the years that we've been working together, but I seem to learn something new every single time. So thank you very much for all of that. Right, let's move on to some of the questions. There are plenty of questions that have been asked and they're still coming in. To kick things off, Peter, you've talked about how planning ahead is key. But what would you say is the optimal time required from a tax and financial planning perspective to start planning your return?
I think that's a great question, actually. So ideally, I would say we're looking at an 18-month to 12-month lead time before the date you're planning to return to the UK. Now, that sounds like it's a long time, but actually, it may be the case you're going to become UK tax resident many months before the date you physically move to the UK. So you want to make sure that you've understood that in plenty of time. But also, there may be some actions that we're going to suggest to you if I'm helping you with this move to say, well, you want to think about selling that UK property, well, you can actually do it with the 5th of April 15 valuation, only the gain from then being charged to UK tax. And of course, a property can take quite some time to sell. So I think summary 18 to 12 months before your planned return to the UK is a great time to think about implementing some of these steps to save you some UK tax.
Great, got it, thank you. A question from Stephen Morris. Thank you, Stephen, for your question. Is capital gains tax always payable on a property bought in the UK whilst resident overseas, even if one returns to live in the UK in that property and then sells it at a later date?
Yeah, that's a great question. And it's going to be a typical tax advisor's answer is it depends. So we do need to look at the circumstances individually for you. There are ways to maximise what we call main residence relief, and main residence relief exempts gains from UK capital gains tax. If you've had a property in the UK that you used to live in as your home, you've been away from the UK working overseas for some years, you come back and live in that property once again, you can maximise what we call your main residence relief. But there are various different moving parts to this. The period that could be exempt would be what we call a period of absence while you're away. And that could be 3 years, it could be another 4 years, and it could be all of the time that you've been living overseas. It really does depend on your personal circumstances. So I'd be delighted to have a discussion with you about that. Takeaway, the answer is not simple. You do need to speak to somebody because the rules are unbelievably complicated on main residence relief.
Got it. Thank you, Peter. Another question can I transfer one property to my son before moving back without any penalties?
Likely not. It is a chargeable disposal for UK capital gains tax purposes, that gift. So you're going to gift a property to a child. It's a chargeable disposal. You do need to report the disposal within 60 days. You need to pay any tax due within 60 days. The advantage of doing that as a non-UK tax resident, if you've owned the property for many, many years, is you're limiting the chargeable gain to only the gain arising from 5th of April 2015. The caution here is that if you're making the gift, you're not going to have any cash in return to pay any capital gains tax due. And you've only got 60 days to pay the capital gains tax. So please do make sure you've understood if there is any tax to pay, so you've got the money ready. The other thing to say is just a very brief mention on inheritance tax. Making outright gifts to children of assets during your lifetime is a great way to get that asset outside of the scope of that 40% inheritance tax charge. But to make that gift effective for inheritance tax, you need to be really sure you're not retaining any benefit in that gift. It must be an outright gift with no strings attached and no benefit to you in that gift. And if you do that, once you've survived for more than 7 years after making that gift is then outside of inheritance tax estate.
Right, thank you. Okay, next question. This question from Robert Lloyd. Thank you, Robert. My wife and I deem ourselves with a domicile of choice in Hong Kong and have domicile statements to confirm that status. Can it be challenged by HM revenue if we both receive a UK state pension?
Okay, so receiving that UK state pension in and of itself is not going to prejudice your non-UK domicile of choice in Hong Kong. But do look at that overall picture. What are your connections with the UK? What are your intentions for the future? Great to hear that you've got a domicile statement already written. That's great ammunition. I think with a domicile of choice, and apologies, this is going to sound really morbid, is that a domicile of choice, you can't get HM revenue to agree this during your lifetime. So it's only ever challenged when you've actually passed away. So having all of the ammunition for your executors and administrators to fire back at HM revenue if they did ask about it, it is great. It's good to hear that.
Great, thank you. Next question for you then. When you say sell gains and keep losses, are these gains or losses within that tax year or over the lifetime of the holding?
Yeah, that's a great question, actually, and we do need to be a bit clearer on this. So what we're looking at is the gain arising over the life of your ownership of the asset. So perhaps you have some shares. What we're looking at is how much gain is accrued from when you acquired those shares to the date that you're looking at now. And it would be that gain that would be within the charge to UK capital gains tax if you become UK tax resident. Now, generally with investments, after you become UK tax resident, there is no relief for the time you invested while you were non-resident. One or two little exceptions to that, but generally with shares, for example, you're not going to get any kind of rebasing or uplifting cost because you actually acquired the shares overseas. So if it's standing at a gain from when you acquired it, you need to take the action to sell those shares before you become UK tax resident.
I see. Okay, moving on then. Are you suggesting that if the family leaves and the money earner stays, then there could be a charge to UK residency at that date?
Yeah, so what we're saying with that example, I think it was actually in both the examples, let's back up, it was Duncan, wasn't it? I have the names in my mind, but I needed to make sure I wasn't going to say the real name. It was Duncan. So what happened there was his family moved back to the UK in June 2018. And the mischief with that is that they started to have a home in the UK in June 2018. And what that meant was that Duncan became UK tax resident in June 2018 when his family started to have a home in the UK. And from the date that Duncan became UK tax resident in June 2018, from that date going forward from there, he was fully charged to UK income tax on his worldwide income and indeed capital gains tax too. And for him, what this meant was that from June 2018 through to November, when he returned to the UK, all of the salary earned in that period was subject to UK income tax because he'd become UK tax resident before his physical move to the UK.
Right, okay. Here's a question that I'm very interested to hear the answer to. Is there an ideal time to return? For example, just before or just after the tax year ends?
Yeah, that's another great question, because if all of your circumstances are wholly within your control, I think the simplest plan is to aim to become UK tax resident at the beginning of the tax year. And what that means is that you're avoiding the complexity around those split year treatment rules, because they can be complex, and as you've seen, they can go awry. I think if you aim to become UK tax resident on the first day of the tax year, that gives you a really clear date. But of course, real life isn't like that. Sometimes you don't have a choice about when you come back to the UK. So then you need to take that really careful advice around the split year treatment.
Okay, thank you. If someone who has invested in an ISA whilst in the UK then moves overseas, can the ISA be retained?
Yeah, absolutely. The ISA can be retained The restriction is you can no longer make contributions to an ISA, but actually that ISA is absolutely fine to retain.
Okay, great. And what are the rules around bringing cash back to the UK from a tax-free jurisdiction? And for example, how much cash can be brought onshore from a Jersey account during a tax year?
There's really no restriction on that at all. So if you're non-UK tax resident and you've been outside of the UK for more than 5 years, there's absolutely no restriction on what you can bring into the UK in terms of cash from a tax perspective. So that isn't an issue. The issue would be the bank and their anti-money laundering provisions, because if you're going to bring in a sizable amount of cash into a UK bank account, that's going to ring all sorts of alarm bells with the bank if they don't understand how that money has arisen in your hands. So if you're going to bring a lot of money into the UK, if you're a long-term non-resident, there's no tax issue, but you do want to speak to your bank first so that they don't get surprised with this large amount suddenly turning up in your bank account.
Is unvested stock, which is part of a bonus payment, UK tax payable if resident when vested? So, for example, the cash element of a bonus, or is it treated differently?
Okay, so if we're looking at, hopefully I've understood the question correctly and we can follow up if not. So if we're looking at something like restricted stock units, we see these really, really commonly. So perhaps you're awarded some stock and in 3 years' time, that stock will be paid out to you. So we call that, the award is grant, and when the stock is paid out to you, that's vest. And usually it's a 3-year wait. And what they're trying to do is tie you into the company with the promise that you stay with us and you have this stock vesting in 3 years' time. Probably easiest with a really simple example, if I can give it, is that perhaps you've got that 3-year period and you become UK tax resident after the end of year 2. And what that would mean over that 3-year grant to vest, you've got 2 years of non-residence and 1 year of residence. And generally what happens is that you've got 1/3 of that period as UK tax resident. So when the stock vests, 1/3 of the value of the shares will be charged to UK income tax and national insurance contributions. So you do get relief for the time between grant to vest when you were non-resident, but if you're UK resident when it vests, there is going to be some UK tax and national insurance to pay.
Right, thank you. I think we've got time for a couple more questions, so if you don't mind, we'll keep firing them at you. Any difference in tax payment to buying UK property prior to moving to the UK or purchasing it later after you've returned?
Yeah, that's a really, really interesting point, actually, because if you're purchasing in England and Northern Ireland as non-UK tax residents, the tax that you pay on purchasing a property is called stamp duty land tax. And purchasing as non-UK tax residents means that you have a 2% surcharge on the stamp duty land tax that you pay. So if the stamp duty land tax rate was, say, 10%, you'd pay 12% as a non-UK tax resident. But if you purchase after you return to the UK, then you lose that 2% surcharge and it would only be 10%. There is a surcharge to pay for purchasing as a non-UK tax resident. It's a little bit complicated, stamp duty land tax. But if you become UK tax resident and you're UK tax resident for a qualifying period after purchase, then you have the ability to reclaim that 2% surcharge that you paid. There are other surcharges that kick in if you're purchasing an additional property. So if at the end of the day of purchase, you own more than one property, you're likely to have a 3% surcharge as well as the 2% surcharge for purchasing as a non-resident. It's all very complicated. Stamp duty land tax is its own niche little bit of area of advice, and we'd be happy to talk you through the rules. Perhaps that's another webinar for another day.
Yes, definitely. Lots of questions here today on property, so perhaps that's something we should plan in. If my wife and children moved in with parents on returning to the UK, rather than having a home in mine or my wife's name, could this still lead to becoming UK tax resident?
Okay, it's going to go back to my answer. It depends. We need to look at the circumstances on this. So what we're looking at is there a date in the tax year when you start to have a home in the UK? It's very much going to depend on the circumstances of the accommodation and occupation of your perhaps parents-in-law's house by your family. Does that have the degree of permanence and continuity that would indicate it's a home for them? Possibly it may do, in which case it would trigger UK tax residence for you because there's a date when you start to have a home in the UK. But with a careful piece of advice, it may be the case that you can avoid the occupation of that property by your family as being a home, because it is actually staying with parents rather than having that permanence and continuity that you're looking for in a home. So maybe there is a strategy you could develop there, but you would need to take some very careful advice. HM Revenue look at these things with a deal of scrutiny. So you want to make sure that the arrangements you have would stand up to that. So it depends, I think, is the answer.
Got it, thank you. Peter, thank you. We're just about coming to the end of our time now, but before we close things off, I'd just like to ask one last question. Based on your experience of working with many clients over the years and helping them plan their move back, what would you say is the biggest or most common mistake that you see happening?
Yeah, that's a really good question. So I've been helping people move back to the UK from overseas for the last, well, since 1997 is when I started in this kind of role. So it's been a long time. And I think by far the most common mistake I see people make is around that split year treatment. That's the one that I see going wrong time after time after time. And it's usually completely unintended, just a lack of awareness of those really, really complicated rules.
Great, thank you very much, Peter. I think that's a good note to finish up on. Thank you very much for sharing your insights and tips, Peter. A big thank you to our guests for joining us today and also for asking so many great questions. I did try to get through as many as possible, but I'm afraid there's an awful lot unanswered this time around. I know many of you are familiar with the Fry Group. For those who are new to us, we are a 123-year-old business. We provide tax, estate and financial planning advice from our 8 offices around the world. Our core purpose is to help people, whether that's our clients, our team, or the communities that we operate in, to help them achieve their financial freedom. And very recently, we were announced as number 5 in the FT Advisor's Top 100, an accolade we're extremely proud of. Now, if we can help you with your tax, estate, or financial planning needs, if you have questions perhaps that we didn't manage to get to answer today, we would love to hear from you. Please do get in touch. Details of how to contact each of our offices are here and will be followed up with you afterwards. And that just leaves me to say thank you very much to all of you for joining us, and we hope to see you again very soon.